Dear traders, when you open your Nikkei 225 chart, price just closed at 62,417, below the 63,330 zone that was supposed to be the floor. The daily trend is still officially bullish, but that close is a loaded gun. Most traders see this and freeze. Today I'm going to show you why this is a textbook institutional trap, how US dollar to Japanese yen is silently confirming the next move, and the exact 3 levels where capital will be made or erased. There is one danger zone and one hidden opportunity. I'll give you both. Here is the instant market verdict. The Nikkei 225 session bias is a controlled fade within a larger bull structure, meaning we expect sideways to slightly lower probing unless and until 62,382 is reclaimed with volume. That number, 62,382, is your line in the sand today. Write it down. If we close a 4-hour candle above 62,382, the whole bearish breakdown thesis shifts to a deep liquidity grab, and we flip cautiously long. Until then, the pressure is down. Walk the chart with me from the top down. On the weekly time frame, the Nikkei 225 is still a monster uptrend. The 20-week moving average sits miles below us. The 60-week is sloping up like a runway. But the MACD on the weekly has begun to roll over with a histogram contraction that whispers exhaustion. The daily chart tells the real story. We had a clean series of higher lows, and then yesterday price gapped lower, shook around the 63,330 area, which had been our 20-day moving average and prior structural support, and failed to hold. The 200-day moving average is way down near 58,000, so this isn't a trend-ending collapse yet, but it is a fracture in the short-term architecture. The 60-minute chart is even more revealing. Price is oscillating just below the 60-period moving average on the hourly, and the MACD on the 4-hour is diving with no bullish divergence in sight. Buyers tried to step in at 62,600 and got run over. The daily resistance for today sits tight at 63,250, and then the heavy wall at 63,680. Support is not a single line but a zone, 62,200 to 62,000. Below that, the air gets thin fast. And here is what most traders miss. This Nikkei move did not happen in a vacuum. You must overlay US dollar to Japanese yen right now. US dollar to Japanese yen is grinding lower, stuck in a tight range above 140, with every tick down whispering intervention fear. The Bank of Japan hasn't pulled the trigger yet, but the market is pricing in jawboning. When US dollar to Japanese yen drops, the yen strengthens, and that instantly strangles the Nikkei 225 because Japanese exporters get crushed on repatriation value. The narrative is set. The yen carry trade is being quietly unwound by funds that are afraid of a sudden BOJ surprise. So the Nikkei's breakdown below 63,330 is not random. It is the equity leg of a yen pressure valve. If US dollar to Japanese yen slices below 139.80 in the next 48 hours, I expect the Nikkei to test 61,500 with zero mercy. If US dollar to Japanese yen miraculously recovers above 141.20, then the Nikkei is simply doing a fake-out and will rip back through 63,600. The two assets must confirm each other. Right now they are both pointing to the same risk-off leak. Let's connect the fundamental driver. The 24-hour core news is straightforward. Japan stocks closed lower, Nikkei 225 down roughly 0.5%. That sounds small, but it was the second consecutive daily close below the pivot, and volumes were elevated. The overnight US session saw tech futures flatten, and the 2-year US-Japan yield spread compressed again by 3 basis points. That compression is the fuel for yen strength and the poison for equities. My 1 to 2 week directional lean is cautious short bias, targeting a mean reversion to the 61,800 area, where the 100-day moving average and a volume-weighted support sit. The invalidation for this lean is a decisive daily close above 63,700. If we get that, the bearish thesis is dead and we chase new highs. Most people will skip this next part, but this is where money is made. Keep watching. We are going into the 3 trade setups. Strategy 1, the sniper, for conservative traders. You do not enter yet. You wait for a failed breakdown reversal pattern. The exact trigger is a 1-hour candle closeback above 62,800 with a follow-through push above 62,950. Only then do you go long. The logic is that if the market is trapping shorts below 62,400, then institutions will need to reclaim the broken support aggressively. Your stop loss goes at 62,380, just below the swing low of the trap zone. This gives you about 400 points of risk. Target 1 is 63,250, the first daily resistance. Target 2 is 63,600, offering a risk-reward ratio of roughly 1 to 2. This setup is voided if US dollar to Japanese yen makes a new intraday low while Nikkei is flirting with 62,800. The correlation violation means the sniper shot isn't clean. Strategy 2, the active trader, this is a mean reversion play. Entry condition is a limit order to short at 63,130 with a stop at 63,420. Here is the reasoning. The 63,130 level represents prior intraday support that has now flipped to resistance, and it aligns with the falling 60-period moving average on the 4-hour chart. You are selling into the first retest of the broken zone. Target 1 is 62,450, which locks in about 680 points of profit. Once target 1 is hit, move your stop to break even and let the rest ride to target 2 at 62,150. Right at the lower boundary of the support zone. Risk-reward on this is attractive, roughly 1 to 2.5. The trailing stop rule is strict. If after reaching target 1 the hourly MACD hooks up, you exit the remainder manually. No heroics. Let's see how aligned we are. Type your Nikkei 225 range for tomorrow's session in the comments now. For example, 62,100 to 63,200. I am reading them. And that interaction gold tells the algorithm you're a serious trader. Strategy 3, the aggressor, is only for those who understand tight risk and aggressive position sizing. This is a counter-trend fade on the 5-minute chart. If price spikes down into 62,100 within the first hour of the Tokyo Equity Open and prints a bullish engulfing candle with RSI divergence on the 5-minute, you go long with a 10-point stop below the spike low. Let's say at 62,060. This is a pure liquidity grab trade. Target 1 is 62,550. Target 2 is 62,900. The risk is tiny, but the probability is lower because you are fighting the 4-hour momentum. If US dollar to Japanese yen is simultaneously crashing below 140.00, do not touch this trade. I repeat, only for those who know how to lose small and manage risk aggressively. Risk management pulse. Never risk more than 1 to 2% per trade. No positions through the BOJ speaker headlines or US ISM numbers. Stops are non-negotiable. Here is your closing anchor. The one most critical level for the next session is 62,382. Below it, the bearish structure breathes and we target 61,800. Above it, this entire breakdown becomes a springboard for a violent short squeeze. Tomorrow we pivot focus to whether the Bank of Japan governor's scheduled remarks accelerate the yen bid. If the US dollar to Japanese yen and Nikkei divergence widens, that's our edge. If you want the full breakdown on Bitcoin and the S&P 500 divergence, that video is live on the channel right now. Check the end screen. Smash like if this analysis gave you a clear, tradable plan. Subscribe and hit the bell. Daily coverage of 8 assets. No fluff, just levels. I'll see you in the next one.